We wanted to figure out if and when we could live off the income our real estate properties generate.
We looked at different scenarios with our 3 properties to see where we would land.
Because we believe you don't need a mega real estate portfolio in order for it to help you retire early.
So let's see if we're right. In 5 years, we could be making anywhere between $30,000 to $92,000 in passive income through our properties. Now, there's quite a big gap there, and that's because there's a lot of variables and options at play when investing in real estate. Investing in real estate provides a lot more flexibility and options compared to stock market investing, but it's also a lot more complicated and harder to predict the numbers for projections. If the worst case is we make $37,000 in passive income, we're okay with that. Because there are a lot of variables at play, we've broken it down to 3 different scenarios that could play out.
Right now, our real estate makes up just under 40% of our total investment portfolio. Real estate is something we love to track month to month, but you don't get to see a lot of the perks at the beginning. Generally, what's happening is your tenants are paying down your mortgage and the value of the properties are ideally going up. It's fun for us to track these numbers and get a better idea of what it would look like if we sold the properties. But realistically, we're not experiencing a lot of the impact right now, and we don't actually plan to sell these properties. So this is the first time we're really sitting down and looking at the numbers and when we'll really benefit from it. When we first got into real estate, we had a pretty limited knowledge of it, but we knew that it was an investment channel we were really curious about and just kind of believed in. We didn't totally know what to expect, and we knew that a lot of the benefits come later. So it's kind of cool to be sitting down 5 years later and feel more confident in breaking down those numbers and really playing out the different scenarios to see what we could do with it and when we could do that. Right now, we currently have 3 properties, 2 of which have long-term tenants and 1 we're operating as a short-term rental. Our 2 tenanted properties have actually both had the original tenant the whole time, but with one of our properties, we actually just had a tenant give notice, so it's gonna be our first time that we're having a turnover there. Right now, we cash flow about $15,000 to $17,000 a year from the 3 properties combined. Our first property generates about $150 a month, which is really just nice for if there's any repairs, but that comes out to around $1,800 a year. Our second property, we're actually technically generating $1,300 a month in cash flow, so that comes out to closer to $15,000 for the year. And lastly, with our short-term property, right now we're actually sitting at negative $2,000 for the year, but we still have the fall rental season to rent out, and a lot of people don't book yet. So we're planning to break even at least for the cottage this year and hopefully actually be a little bit profitable when we see those last bookings come in. So how do we go from $15,000 cash flow right now to that $37,000 and $92,000 in 5 years from now? Let's look at those 3 scenarios.
So for scenario 1, we are gonna look at if we did nothing, if we just kept everything status quo as it is today. That would mean we would continue operating our short-term rental as a 3-season cottage, operating from May to October with about a 60% occupancy rate. And in this scenario, we're looking at if our current tenants stay for the next 5 years. Where we live, the government caps how much you can increase your rent every single year, and that number is typically between 2 to 2.5%. With our first tenants, we didn't really raise rents for the first few years, but after that, we realized we were a little overly generous, and it eventually cut into that little cash flow that we were generating every single month, which then led to us losing money on a monthly basis. So in this scenario, just to make sure that we can keep up with the costs, we are gonna increase our rents annually by 2.5%. A few other considerations that we're gonna apply to all scenarios, because there's too many moving parts and variables within these calculations, is that expenses increase 1% every single year, and every 5 years we're gonna have to renew our mortgage, and hopefully it'll be a lower monthly mortgage payment than before. This is because the principal, the amount owing in your mortgage, is now less because of the last 5 years of you paying down your amount owing. The other variable affecting your monthly mortgage payment is your interest rate. Right now, we're sitting around about the historic average. So I'm just gonna assume that the interest rate is gonna be roughly the same. There's not gonna be big jolts up or down. But again, that's hard to predict. So we're just making that as an assumption. By that 5th year, we should be able to generate $37,000 through our rental properties.
In our second scenario, we're looking at if we winterize the cottage, which is something we're planning on doing to make it a 4-season rental, and if at least one of our tenants swaps out for a new tenant, because with the two properties, realistically, that's going to happen at least once. Starting with the cottage, it is part of our game plan at some point over the next 5 years to winterize, hopefully sooner than later. So we feel pretty confident banking on that in this second scenario. If we were to do that, and if we were able to maintain a similar occupancy rate that we have right now with our availability at around 60%, that would mean that we could make almost 70% more with the cottage, which is obviously going to be pretty impactful on the income and passive income that it's bringing in. Now, if we look at the long-term tenant side of things, when a new tenant comes in, you can more easily raise the rent because you're no longer restricted by that provincial 2.5% rent increase max. Now, we're not just doing this to be evil landlords, increasing for the sake of increasing, but usually what happens is over those 5 years, the property has probably gone up in market value and the market rent for that area has probably increased as well. That's why we see people staying in buildings or properties they've rented for a long time, because they really have a great rate compared to maybe what it should be based on the current market. So this actually means that if we're looking at 5 years from now, we'd be able to increase that rent about 25% from what it's at right now. So if you want the numbers behind that, essentially what it is over the last 30 years, the average rent in our city has increased about 5%. So if we look at 5% each year over the 5 years, that's how we land on an increase of 25%. For some of us, we like to get a little bit nerdy with the numbers. If that's a little overwhelming for you, just think about the fact if we winterize the cottage to make it 4 seasons, and if one of our tenant turns over, we're probably looking at around $66K in annual passive income from our properties 5 years from now. This one is probably our most likely scenario because we are planning to reno the cottage and we do expect at least one of our tenants to turn over. So this is kind of exciting to me because I honestly thought we wouldn't be able to profit from our real estate until we were well into our 50s or 60s or later retirement years. So it's really interesting to see that as soon as 5 years from now, we could be pulling almost $70K from just our properties.
And lastly, we have scenario 3. This is where the best case scenario plays out for all our properties. This would mean both our long-term tenanted properties would turn over in that 5th year, which would mean we would increase our rents by 25% to match current market rent at that time. And for the cottage, we would winterize it so we could rent it all year round and really push that occupancy up to about 90%. We know that's a high occupancy number, and we're not just making that up to make the numbers work. I actually looked at comparables of other Airbnbs in our area, and some properties do 90 to 100% occupancy. So if they can do that, why not us? Assuming that all the best case scenarios do happen, in 5 years, that would result in about $92,000 in passive income generated from our properties alone.
We love to look at these different scenarios because it really gets us an ability to gauge what our options are and really a fuller picture. And we laid it out in these 3 scenarios for the sake of simplicity to kind of compare those numbers at one point in time. But we want to take you guys through our full process, which we actually do, is looking more at the numbers like this. So when you look at this, we can really compare all of these different scenarios at different points in time. Because if we're only looking at them at one point in time, those numbers might tell a specific story. But if we start looking at 3 years, 5 years, 8 years, 10 years, those numbers could tell us a different story that might be more enticing and might spark a different path that we weren't thinking about. Truly, there's no single blueprint when it comes to investing, or even once you acquire properties, there's not one blueprint of how you navigate those. So for us, looking this in depth at it allows us to look at options. For example, if we know that we probably don't want our cottage at 90% occupancy every year because then we don't have that much time to enjoy it. So we can look at, okay, this might be the most aggressive scenario if we do want to get those investments really going. But then we can also look at the opposite end of, hey, if we want this cottage to become something that we just get to enjoy and maybe eventually we're not renting it, we can look at how that affects the numbers. Doing this really keeps us informed, and we talk a lot about staying close to the money in that early personal finance journey of you want to know what you're spending and your cash in and out looks like, but this is what we talk about when it's staying close to the money and keeping yourselves informed once your stuff gets more complicated.
After looking at all three scenarios, it's pretty motivating and pretty cool to see how this could play out. Never thought that this would happen so quick. As Mel mentioned, for us, real estate has always been a really long-term play, and we didn't think we would benefit from real estate this early on.
Yeah, to be honest, this is really interesting because I feel like we're trying to be very ambitious with what we're investing in the stock market in order to hit certain milestones for what we can pull out at 40. And so looking at this really makes me want to go back to the notebook even one more time to think about, should we be considering our real estate more as the optimal play, or what should we do?